Welcome back to Investing Talk Podcast.
Today we're looking at CoreWeave.
As usual, before we start, subscribe, like, and comment to this video to support the show. Because today is a genuinely wild one. You post the fastest revenue ramp in the history of cloud computing. You secure a backlog of future orders that literally eclipses the valuation of most Fortune 500 companies.
Yeah.
You beat consensus estimates cleanly, and your reward from a market.
A brutal, almost 10% sell-off in after-hours trading.
Right, exactly. Welcome to the show. Today we are tearing into CoreWeave. They just released their Q4 2025 earnings, and it has left the market completely polarized. We are looking at a company sitting on a mountain of locked-in future revenue, yet investors are reacting as if the sky is falling.
It is, one of the most fascinating disconnects we've seen in infrastructure tech in a long time. You have a company that is fundamentally pouring the concrete for the artificial intelligence revolution.
Yeah.
I mean, they're hitting growth milestones at an entirely unprecedented pace.
But the immediate reaction is just panic.
Severe anxiety, yes. We are seeing a real-time stress test of how much capital expenditure Wall Street is willing to stomach, even when the underlying demand appears absolute.
And that is the core mission for us today. We need to look under the hood and untangle these conflicting signals. Are investors just exhibiting generalized anxiety, getting spooked by the sheer size of the short-term spending, or is there a genuine structural flaw in CoreWeave's explosive growth strategy that the market is correctly pricing in?
To get to the bottom of that, we have to look closely at the architectural and financial realities of what CoreWeave is actually doing. They aren't just an alternative to your standard cloud host. They are providing the specialized picks and shovels for the modern AI gold rush.
Right.
But mining for that gold specifically, building the data centers capable of handling advanced AI workloads, is becoming exponentially more expensive.
Yeah, the physical cost is just ballooning.
Exactly. What we are seeing play out is a profound tension between aggressive, debt-fueled physical expansion right now and the promise of massive high-margin cash flow a few years down the line. The market is basically asking, is the cost of carrying this infrastructure going to crush them before they reach the finish line?
Let's transition over to the fundamentals because the top-line numbers are undeniable. Let's look at the scoreboard. In Q4 of 2025 alone, CoreWeave reported $1.57 billion in revenue.
Staggering.
It is. That is up 110% year over year, and it cleanly beat the consensus estimates sitting at $1.55 billion. Furthermore, for the full year of 2025, they crossed the $5 billion revenue mark. They are officially the fastest cloud provider in history to reach that milestone.
Which is incredible.
But as impressive as a historical revenue ramp is, the market is forward-looking. The number that really jumps off the page is the backlog. Their backlog has quadrupled into $66.8 billion. But help me unpack that, because $66.8 billion is a massive number to throw around. How much of that is ironclad, guaranteed revenue versus, say, soft commitments that could evaporate if the AI bubble pops or if a client shifts strategy?
It's a vital distinction to make. In the context of these infrastructure deals, we aren't talking about letters of intent or projected interest. This $66.8 billion represents secured demand.
So it's real money.
Yes. These are signed take-or-pay contracts, largely driven by the absolute heaviest hitters in the space, primarily Microsoft and OpenAI.
Right.
It means the revenue is contractually locked in for the future, provided, and this is the critical caveat we'll discuss later,
Right.
providing CoreWeave can actually deliver the compute power and the physical racks they've promised on schedule. That backlog is the foundational thesis for the company. It signals that the demand for AI processing isn't a speculative flash in the pan. It's translating into multi-year, multi-billion-dollar financial commitments from the biggest balance sheets in tech.
Which naturally brings up the competitive landscape. If the demand is that obvious and the contracts are that lucrative, how is CoreWeave, a relatively newer entity, thriving against the established hyperscaler giants? You look at Amazon Web Services, Microsoft Azure, Google Cloud. These companies have practically infinite resources and established enterprise relationships. How does a company like CoreWeave build a defensible moat against a trillion-dollar hyperscaler?
It comes down to a fundamental difference in data center architecture. The hyperscalers, AWS, Azure, Google, built their empires over the last 15 years, optimizing for general-purpose cloud computing. Their data centers are designed for CPUs. A standard legacy server rack might draw 10 to 15 kilowatts of power. They are built to be everything to everyone.
Jack of all trades.
Precisely. CoreWeave, conversely, offers purpose-built AI GPU infrastructure. AI workloads, utilizing advanced chips like Nvidia's H100s or B200s, require vastly different thermal and power
They
dynamics.
run incredibly hot, right?
Yes, a dense AI cluster can draw 40 to 100 kilowatts per rack.
Yeah.
You can't just drop 1,000 cutting-edge GPUs into a legacy AWS data center.
What happens if you try?
You'll literally melt the cooling systems or trip the power distribution. CoreWeave is building facilities from the concrete up specifically for the thermal demands of liquid-cooled, high-density AI infrastructure. Because of that architectural focus, they can offer better performance and cost efficiency at scale for pure AI developers.
So the legacy cloud providers are essentially dealing with technical debt. They have a massive sprawling networks of traditional infrastructure, but retrofitting them for high-density AI is slow and incredibly complex. CoreWeave doesn't have that legacy baggage. They are just laying down specialized high-performance tracks from day one.
Yeah, correct.
And speaking of the tracks, they have the ultimate partner supplying the engines. Let's talk about the Nvidia relationship, because this seems like the anchor to their entire competitive moat. Nvidia isn't just a vendor selling them chips. Following a $2 billion investment early last year, Nvidia is CoreWeave's second largest shareholder.
And the strategic importance of that cannot be overstated. From Nvidia's perspective, backing CoreWeave is a defensive maneuver against the hyperscalers.
How so?
Well, AWS is developing its own custom silicon, like Trainium. Google has its tensor processing units, or TPUs. The hyperscalers want to eventually move away from relying solely on Nvidia. CoreWeave, however, is a pure-play distributor for Nvidia's hardware.
So they aren't building their own chips to compete.
Right, they don't compete on silicon. Therefore, Nvidia has every incentive to ensure CoreWeave gets preferential allocation of the most critical, highly constrained hardware in the world right now. It tightly aligns CoreWeave's growth trajectory with Nvidia's own proprietary ecosystem.
But securing the chips is only half the battle. You need the electricity to run them, which is becoming the ultimate bottleneck in the tech industry. The physical metric of their moat is their power portfolio. CoreWeave has secured 3.1 gigawatts of power capacity.
Which is massive.
Just to put that 3.1 gigawatts in perspective, traditional data centers operate at a fraction of that power density. We are talking about fundamentally re-architecting power grids, securing dedicated substations, and navigating years of regulatory utility approvals just to plug these facilities in.
The power constraint is the invisible ceiling on the entire AI industry right now. Having 3.1 gigawatts secured is an asset almost as valuable as the chips themselves. Currently, they have over 850 megawatts active.
And they're building more fast.
Very fast. In Q4 alone, they added 260 megawatts of active power. This was a highly strategic operational push to resolve some prior bottlenecks at specific data centers, proving they can actually navigate the supply chain and utility hurdles to bring secured power online to generate compute.
Let's pivot to the risk section, because we have to talk about the price of scaling. On paper, they look unstoppable. Fastest revenue ramp, $66.8 billion backlog. Nvidia on their side, the power capacity. So why did the market hit the sell button? This brings us to the dark side of the balance sheet and what Wall Street analysts are dubbing the CapEx tantrum.
The tantrum is rooted in the brutal, unavoidable financial reality of scaling physical infrastructure. A $67 billion backlog is fantastic, but you cannot service those future contracts with the servers you have running today.
You actually have to build the stuff.
You have to purchase the silicon, pour the concrete, install the heavy power transformers, and build out complex liquid cooling loops right now. All of that requires upfront capital expenditures, or CapEx, on a scale that is staggering even by big tech standards. You have to pay the contractors and the suppliers long before the revenue from those long-term contracts starts flowing into your accounts.
Let's put the specific numbers to that reality, because they induce vertigo. In 2025, CoreWeave's capital expenditures hit $14.9 billion, and they are projecting that spending to essentially double. They are forecasting $30 to $35 billion in CapEx for 2026 just to build the facilities required to fulfill the signed contracts.
It's an astronomical sum.
To finance that level of hyper-expansion, CoreWeave is relying on a massive amount of debt. We are seeing the pain of that debt structure aggressively hit the short-term metrics.
The income statement for Q4 reflects exactly that pain. When you are spending billions to stand up facilities, your near-term profitability gets crushed.
Looking at those Q4 metrics, their net interest expenses skyrocketed by 160% year over year, hitting $388 million just to service the debt.
Just on interest.
Right. That drag contributed to a total net loss in the quarter of $452 million, which was significantly wider than the expected loss of $342 million. And the operating margins took a severe hit. We saw their adjusted operating margins compress from 16% a year ago all the way down to just 6% in Q4.
It's the classic dilemma of building the airplane while flying it, but scaled up to a macroeconomic level. You have cash hemorrhaging out the door to build the infrastructure, and while the future is theoretically guaranteed, the present looks highly leveraged.
Very leveraged. If you're approaching this as a skeptical investor, looking at the bear case, what is the primary risk?
The primary risk isn't whether AI is a fad. The primary risk is execution delay tied to that massive debt burden. If you are obligated to spend $35 billion in a single year, your supply chain and operational execution must be flawless. There is also the danger of customer concentration.
Being tied so heavily to Microsoft and OpenAI.
Exactly. Being heavily reliant on those giants is a massive advantage when they're in expansion mode. But if they experience a strategic shift or if broader AI software monetization slows down even slightly, CoreWeave is left holding the bag on facilities that require massive interest payments. That 6% margin trough becomes a very dangerous place to live if the top-line growth decelerates.
And execution risk brings us to a specific point of friction that the market is clearly worried about. There has been a pervasive rumor regarding their debt financing. We need to dissect the unconfirmed rumor of a snag in a $4 billion funding deal with Blue Owl.
Yes.
For context, Blue Owl is a massive player in the private credit and alternative asset space. Why are they going to private credit, and why does a snag in a $4 billion deal matter so much when they have $66 billion in the backlog?
They are tapping private credit markets because traditional commercial banks simply will not or structurally cannot underwrite $35 billion in speculative unbuilt data center capacity, regardless of the backlog.
The banks won't touch it.
Right. Private credit firms like Blue Owl specialize in structuring complex high-yield debt for exactly these types of capital-intensive alternative assets. Now, management is pushed back,
Right.
emphasizing that their signed customer contracts naturally mitigate broader funding risks. But the market's anxiety around this rumor is highly logical.
Because the backlog doesn't pay the concrete pours today?
Precisely. If there is friction in securing that private credit, or if the debt covenants become too restrictive, it creates a cash flow bottleneck. It threatens to stall their construction timeline.
And a stalled timeline is a disaster.
If the construction stalls, they can't bring the servers online to service the Microsoft or OpenAI contracts. If they can't service the contracts, the revenue doesn't materialize. But the interest payments on the debt they've already taken on still come due. The overarching fear driving the bear case is that their debt burden becomes unmanageable before the physical infrastructure is fully operational and converting that backlog into free cash flow. It is a high-stakes race against the clock.
That tension perfectly transitions us into the technicals and sentiment. Let's look at what Wall Street is doing with all this data. The earnings drop, they beat the revenue estimates, and the stock immediately drops between 8.8% and 10% in after-hours trading, settling around $92.60. The psychological pressure that institutional investors are feeling regarding that $35 billion capex guidance completely overshadowed a 110% revenue increase.
It highlights a market that is struggling to appropriately price in hypergrowth that fundamentally requires hyperspending. The immediate sell-off was a knee-jerk reaction driven by fear of the near-term capital costs and the ugly Q4 margin compression. But when you look past the immediate reaction and dig into the forward guidance, management is actively attempting to contextualize this pain. They are explicitly pointing to the first quarter of 2026 as the margin trough.
Meaning management believes this is the absolute bottom. Q1 is where the ratio of cash going out to build versus cash coming in from operations is at its most painful, and theoretically the leverage dynamic should begin to improve from there. But the Q1 guidance itself didn't exactly thrill the market either. They projected Q1 2026 revenue between $1.9 and $2.0 billion. That is solid growth, but it sits slightly below the street consensus estimate of $2.3 billion.
Missing the near-term consensus certainly fueled the after-hours drop. However, management's argument is that the market is being myopic. They are urging investors to look at the massive long-term targets. CoreWeave is projecting to exit 2026 with an annual recurring revenue, or ARR, run rate of $17 to $19 billion.
Wow.
More importantly, they expect to hit $30 billion in ARR by 2027.
$30 billion in recurring revenue in roughly 24 months. That completely changes the scale of the company. But revenue is only one part of the equation. What about the profitability? How do they recover from those compressed 6% operating margins we saw in Q4?
They see a very clear structural path for margins to expand back up to the 25 to 30% range as the infrastructure matures. The strategy relies heavily on high-margin ecosystem add-ons. It isn't just about renting out raw GPU compute power anymore.
What's the main driver there?
A prime example is their AI storage solutions. Management noted they are currently seeing an 80% attach rate on AI storage.
80%, that's huge.
It means 8 out of 10 clients who purchase compute clusters are also paying for CoreWeave's highly profitable proprietary data storage networking. Once the massive initial capital outlay for the physical data center is complete, those software-defined add-ons are what will rapidly pad the bottom line and drive free cash flow.
So the question is, who is right? The algorithms trading the after-hours plunge or the long-term bulls? Looking at the professional analyst sentiment, despite the stock taking a hit down to the low 90s, the major firms are surprisingly resilient. They aren't panicking. Evercore ISI is maintaining an outperform rating and kept their price target at $150.
Quite bullish.
Citizens reiterated a market outperform with a target of $180, and Needham is holding a net constructive stance on the stock. They seem willing to look past the current quarter.
The institutional analysts are anchoring their models on the backlog. They recognize the severe near-term volatility and the execution risks associated with the debt load, but they view the underlying demand fundamentals as ironclad. And if we look ahead at the catalyst calendar for the next few months, there are specific events that can shift the narrative back in CoreWeave's favor.
What are the primary catalysts investors should be watching for?
The most immediate hurdle will be the Q1 2026 earnings report in May. The street will be heavily scrutinizing those numbers to see if management was right. Did they actually hit the margin trough, and are there concrete signs of margin stabilization?
And macro factors.
Beyond the company-specific execution, there are significant macro tailwinds. If central banks initiate interest rate cuts, it would be a massive positive catalyst for a company carrying this level of debt. It directly and immediately lowers their cost of capital. Furthermore, the broader AI infrastructure boom shows absolutely no signs of plateauing, which continually validates the necessity of CoreWeave's entire business model.
We have covered a massive amount of ground here today. We've examined the unprecedented pace of revenue growth, the daunting reality of $35 billion in infrastructure spending, the strategic moat built alongside Nvidia, and the tension between debt-fueled expansion and future cash flow. It is time to synthesize this data. Based on the aggregate research and the balance of probabilities, we arrive at an 8 out of 10 bullish score.
That bullish assessment relies on a specific investment horizon. The overarching thesis is that a $66.8 billion secured take-or-pay backlog and a 110% top-line growth rate fundamentally offset the near-term anxiety surrounding capital expenditures.
The debt is heavy, sure.
Yes, the private credit debt load is heavy, and the current operating margins are objectively ugly. However, if you evaluate CoreWeave as a multi-year hold, aimed squarely at that 2027 inflection point where the infrastructure is operational and generating $30 billion in high recurring revenue, the post-earnings sell-off into the low 90s likely represents a significant undervaluation window.
It just requires believing that their operational execution can match their sales ambition.
Exactly.
Which leaves the final assessment to you, the listener. How do you approach this specific style of high-stakes, infrastructure-heavy tech investing? You ultimately have to decide what you value more in your portfolio. Aggressive market capture and hypergrowth at the foundational layer of a new technology, or the safety of near-term free cash flow and protected profit margins. CoreWeave is essentially daring the market to have the patience to watch them build the physical backbone of the next decade.
It truly is the ultimate test of long-term conviction versus short-term financial anxiety. And stepping back from the immediate stock mechanics, the data we've reviewed today leaves us with a rather profound, provocative thought to consider regarding the broader technology landscape.
Lay it on us.
If the foundational layer of artificial intelligence requires a single infrastructure company to spend $75 billion a year just to keep pace with thermal and power demands, what does that mean for the ultimate cost of the AI software and applications we will all be relying on?
That is the multi-trillion-dollar question right there. If the infrastructure is this capital-intensive, the unit economics of the final product have to reflect that.
Exactly. If the specialized picks and shovels are this expensive to manufacture and power, that cost must inevitably be passed down the value chain. Will the sheer physical cost of compute power eventually price out the very software innovation this infrastructure is being built to support? Are we building a specialized high-speed computational rail network that only the absolute wealthiest enterprise corporations will actually be able to afford a ticket for?
That structural economic question changes how you evaluate the long-term viability of almost every new AI startup hitting the market today. It is something to seriously consider as this physical build-out continues. Thank you for joining us on today's analysis into the mechanics of AI infrastructure. Remember to subscribe, like, and comment to this video to support the show. We will catch you next time.